If you look up the term market structure, you will find hundreds of videos rambling about market structure, where you need to define higher highs, lower lows, higher lows, ascending triangles, market profile, volume, and on and on and on. In fact, all this is garbage. It means nothing to you when you want to trade. By the time you define higher highs and higher lows, the trend is already gone. And I promise you, nobody is managing millions of dollars sitting and watching the screen, pointing higher highs and lower lows. They don't do that. So when it comes to trading, we should follow the professionals who are making money in the market consistently year after year. And we should not follow gurus on YouTube, including me, without testing the pattern that they are teaching you. I promise you, by the end of this video, you will be ahead of 99% of traders out there looking to scalp and find the perfect strategy and the perfect indicator, because it all boils down to market edge. I define market edge as the characteristics of the market. A good analogy is, let's say if you have kids, then even though your kids came from the same parents, living in the same house, speaking the same language, but each have different skill. If you are in a sporting team, it's the same thing. Not the whole team have the same skills. Each one excel in a certain skill. If you are in school or university, then the same thing applies. Not all students attending the same class having the same skill. And markets are exactly the same. Every market is traded by thousands of participants, and each has their own fundamental principles that guides the price along the way. So when you hear the term that the strategy has to be symmetrical, that means nothing in the real world. I mean, long-term trend following, I might say, yeah, kinda. Maybe some fundamental strategies long-term will work on all markets. But even then, long is totally different than short. Short usually is very volatile, and it comes with an expansion of the ranges, and it's short. It doesn't sustain for long term. While long term trends, usually it's not volatile and it takes a long time to build. But for short term strategy, this does not exist at all. The long is totally different than the short, and each market behaves totally different in long than short. So market edge is all about finding that characteristics of each market. Does it work well with long or short, with mean reversion or breakout? Once you find that, then it becomes very easy to build a strategy. But of course, like always, we need to test to verify the merit of our thesis. This is the export for crude oil data since 2007. As you can see, I have the date, then we have open, high, low, close, and volume. Then I calculate many things. Most importantly, let's focus on this number. So this number is the amount of dollars we make if we buy the open and sell at the close. So this is the next day, we lose $150, the next day, and so on and so forth. And if you make a pivot table, then you will end up with something like this. So this is the average of the amount of dollars we make for all the periods in the analysis, which is since 2007. So if I buy the open, sell the close every single day since January 1st, 2007, all the way to September 2024, on average, I will be losing about $25. This is not taking slippage and commission into consideration. So here is the first takeaway when it comes to crude oil market, which is overall, it tends to go down more than go up. Because as you saw from the data, if we buy every day, we end up losing money on average. Now you might say, well, some days you lose more than you win. So it makes sense also to see the win-loss percentage. And here is our win-loss percentage. So you see we win more than we lose. That means the close is up more than the close is down. But when the close is down, it travels further, meaning the range is bigger when we are losing. That's why the average is minus instead of plus. So the second takeaway in the crude oil market is the win percent is higher. It's about 7% higher than the loss percent. But because when we lose more, that's why the average is in the minus. So here the edge is not clear. We lose on average, but the win percent is higher. So it's like conflicting results. So here is the euro US dollar, and we can see on average we are minus $6. Here is the S&P 500, and on average we are making about $20. Here is natural gas. On average we are losing $70. And finally here is wheat, and on average we are losing about $37. And here is the win-loss for wheat. On average we lose about $37, but also we lose more than we win. And we see the number of losing trades, 2350 to about 2050. So we almost lose 14% more than we win. So for the wheat market, it's a totally different story. The edge is there on the short side, because on average we lose $37 if we buy every day. The total number of losses is 14% more than the win. So then now these edges align. So for the wheat market, if you only take these two data points, that on average we lose more than we win, and on average the close is below the open, that alone can give you a head start of everybody else, because now you only need to build short strategies on the wheat market. More than 90% of the time, your short strategy will be profitable and will be robust. Now we can go a step further. So on average in the wheat market, we lose about $37. Now I have my market regime indicators. These are proprietary indicators that are included with my algo trading masterclass. And if I include the long-term market regime, we can see also the behavior is different. When we are in bear market, on average, we lose about $20. When we are in bull market, we lose about $70. And when we are sideways, we lose about $45. So for the wheat market, we lose on average, and we lose more than we win. Also, when the market is trending up, if we buy every day, we lose more than if the market is trending down. So those are huge pieces of information that if I define the market, let's say the 50-day moving average above the 200-day moving average, let's say this is our bull market. If I short every day in this bull market, I will make on average $70 a day. I can take this a step further if I put the previous day filter. So this filter is checking if yesterday is an up day. And this probably shows it better. So this is when yesterday is up, and this is when yesterday is down. And we see the difference in the behavior. Yes, all of them still short is better. Because remember, all these are negative. That means every day if I short, I make money. And the difference in this market regime, which is the bull market, when yesterday is up, is huge, because here on average I make $112 per day. Now of course you can take this analysis further and you can see the behavior per month, the behavior per day of the week, but overall we start from the main characteristics of the market, which is wheat works very well with short. That means if you start with a short strategy, you'll be much better off than any other indicator out there. You drill down, and if you define the market in up, down, sideways, you find shorting in up market is much better. And then just a simple filter, which is yesterday is down or up, gets you even further. Now, of course, these filters, this is just one that I used, just one bar, so it's not optimized. But of course, you can use any type of filter like MACD, ADX. The possibilities are endless, but the idea is not to build a strategy yet. We are just defining what this market will do very well with which type of strategy direction. So this is shorting every day. We have about 4,500 trades. On average, we are making $37 because remember, the Excel sheet shows a minus, so I'm shorting here. That's why we are positive. And now I'm going to add the condition to short only in bull market. So let me compile. And now we are down to about 1,000 trades and our average trade went to almost $72. And now if I add the condition of yesterday's bar is up, meaning just yesterday, the close is higher than the open. So let's compile. And now we are down to about 530 trades with $124. So this matches my Excel sheet perfectly, like in every step of the way. The starting, which is about $37, and then the bull market, which is about 70 something dollars. And then when we add the filter of yesterday's bar, we end up with about 530 trades with about 120 plus dollars on average. This average is alone is you can work with, like this can be a strategy already. But that is not how you use Market Edge. You use Market Edge to define what is the best direction for this market to go long or to go short, and which strategy style to use. Is it mean reversion or breakout? Because again, each market has a separate behavior for mean reversion or breakout. And if you start with this information, it will be a lot easier to build profitable, robust strategies. Also, this information make it really clear that not every strategy will work the same way, long or short. Or not every strategy that works on market A will work on market B because of this inherent behavior in each market. If you like this video, then you will love the next video.